Markets continue to leak lower as we get ready for what is the tentpole event for markets this week. No, it's not the meeting of President Trump and Prime Minister Mark Carney of Canada, although that certainly stirred up a lot of interesting pronouncements today. No, it's the Federal Reserve monetary policy announcement. We're going to dig into exactly why the markets are so soggy ahead of it and what it may bring here on Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. We're going to start just with a look at what the markets did here and why they are setting up the way they are for this announcement, and then take a look at what the announcement may bring and what the trade opportunity is shaping up to be in its wake. So here's just a kind of stage setting look here first and foremost at the S&P 500, and you can see here we kind of hit this former resistance at 57.24 thereabouts. You can see that there is a sort of range that's set up right here. Very tellingly, of course, this was the place where we gapped lower on Liberation Day. This was the sort of congestion range established after the markets initially got their growth scare around the deployment of tariffs in the beginning of the year. They paused to consider what happens next. Then we get Liberation Day, which of course gives us I dare say, something currency crisis adjacent kind of an episode where bonds, stocks, and the dollar all crater simultaneously in response to the president's tariff policy clarification. Then, of course, we walk that back, and at least the tariffs north of the new baseline of 10% are put on at least a temporary hold, and there's a massive rally. We then threaten to fire Chair Powell and then not, and ultimately that's what unclenches markets more convincingly. Notice we've basically erased all of this kind of sovereign risk kerfuffle, but only that, and have stopped exactly where Liberation Day would have left us were it not to have occurred at all. And so the interesting bit, of course, is since the beginning of the week, the markets have walked back a bit from those levels. It's not at all clear that the rally is over, but at the very least, it has stalled at both a level of inflection for price before, and clearly see it here with the naked eye, and also a kind of a critical inflection point in terms of the narrative and in terms of time. Now, as far as the Fed policy announcement itself goes, the expectations are very clear that the Fed is not going to do anything with rates at this meeting. We can see there's no change that is baked into the cake here until you get to July, September, and of course there's no meeting in August. But we can see here that we go from 4.38, the effective rate currently, because of course the Fed sets things in ranges. That's the midpoint, the effective rate currently between the Fed's target range of 4.25% to 4.5%. To get to one cut being priced in, we'd have to get to 4.13, and you can see that falls somewhere in between July and September here, which of course makes sense. That July meeting is on July 30th, so right at the end of the month. So indeed, if the pricing structure here is telling you that there's no cut in July, it's because for most of the month there isn't one. But it happens just as the calendar turns to August, right before then, and so by the time you get to September, obviously we're sub 4, and we already have that first cut on the menu. From there, another cut is already on the menu for November. We'd have to get to 388 there, and of course by November we're already there, 371, and to get still a third cut from there, we'd have to get to 363, and you can see we're already lower than that, 358 for December. So you can see them here. Cut, cut, cut. 3 of them on the board. And so if you look at the overall structure here, you can see very tellingly, here's your 3 cuts, almost to the basis point baked in here. And for next year, 1 cut. A little bit extra if we consider the 29 basis points versus 25, but only just barely so. So what you then drill down on is 100 basis points in overall easing. Of course, there's some rounding here, but clearly this is in line with the Fed's own forecasting. This is, in fact, what the Fed has been saying since December. Here's the December projection. It was to go from 4.4 down to 3.9 this year. By the way, why 4.4? 4.4. There's the current effective rate. So from 4.4 to 3.9 is 50 basis points. From that down to 3.4 is another 50 basis points. So the Fed agrees with markets, and they agree with the Fed. We're looking at about 100 basis points in cuts between now and the end of next year. But clearly the Fed is looking at 50 basis points spread evenly over that forecast, whereas the markets want more urgency. They want 3 rate cuts up front and 1 next year. Why so? Well, we've gone over the reasons in detail before, but we'll do it again here briefly. Of course, we just got the latest batch of PMI numbers from the U.S. this week, reinforcing the idea that a cool down in the service sector has given us basically standstill on U.S. economic activity growth, down from the headiest levels that we'd seen since early 2022, where, incidentally, we hovered for most of the second half of last year. But as soon as the calendar turns to January, well, that falls apart. And so we are now basically at no growth at all, or barely any. Of course, this is, as ever, in the logic of PMIs, so 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So at 50.6, we're growing, but only just barely so. And in fact, at the weakest pace here, referencing back 17 months. A competing PMI survey, again, finalized this week, comes from ISM. They have a slightly weaker view of manufacturing, 48.7 versus 50.2. They have a slightly stronger view of services, 51.6 versus 50.8. But the bottom line, we're somewhere around 50 and change, maybe a little bit north of it, for a weighted composite, considering services is, of course, a much larger part of the economy than manufacturing. We're probably tilting to the positive side of 50 because the weight from services here probably matters more in any kind of composite construction than does manufacturing, because of this asymmetry in the economy. And so the bottom line, net, seems to be to land a little bit north of 50, which is exactly what we get from S&P Global. In other words, we've slowed to near standstill, and you can clearly see the direction of travel here. Basically, since the beginning of the year, these things are going down in tandem, much as we get from the other PMI as well. So there's quibbling at the details, but the overall story is of economic deceleration, and that part is absolutely unmistakable. So why won't the Fed cut? Well, we've heard them talk extensively around the idea that what these things are, ISM and S&P Global, and for that matter, consumer confidence surveys from the Conference Board from the University of Michigan, which are likewise flashing bright red, that this is survey data and sentiment-based. Granted, it's a very good proxy for GDP, especially the PMI numbers. But What the Fed wants is something more concrete. It wants to hang its hat on some kind of set of hard numbers. And we can see from their forecasting what they think the trajectory is and what they're worried about. Take a look at the change in projections for growth and inflation despite the stasis on rates. We adjust to lower growth from 2.1 to 1.7, from 2 to 1.8. We reprice to higher inflation from 2.5 to 2.8. For the core, a little bit more stable. For the headline, even for next year, from 2.1 to 2.2. And of course, this lines up exactly with what Chair Powell told us both when this meeting occurred in March and since, which is that they have no idea how these tariffs are going to impact the economy, but what they know historically is that tariffs tend to raise the prices of stuff because they are essentially a consumption tax on imports, and that this tends to weaken growth because then people have less money to buy stuff and buy less of it. And of course, we know that the biggest component of the economy by far is household consumption. So we know what the Fed thinks are the risks: weaker growth, higher inflation. We know that this pulls the Fed in divergent directions. Weaker growth says rate cuts, higher inflation says no rate cuts. And so the Fed is saying, we just don't know, and we're not going to make a call until there is hard data telling us which way we need to jump. And yes, we see the survey data, but we need it to be more concrete. We need not just for businesses to be afraid, we need for actual pain to materialize. So far, that has been somewhat difficult to engineer. Here is the data that you have most recently, of course, from the GDP report. And ostensibly, you have your kind of hard data slowdown. The 0.3% contraction in GDP is the first negative quarter in 3 years. Last time was the 1% decline in the first quarter of 2022. So, okay, do we have the hard data? Well, not so fast. If we look at the internals of that GDP report, and we've discussed them in granular detail here before, much of that negative number was the off-the-charts surge in imports. And since GDP is consumption plus investment plus government spending plus net exports, that is exports minus imports, this little sliver of imports minus this big chunk of imports obviously gives a huge downdraft on growth. Now, overall, the export sector is tiny relative to overall GDP. Net exports are maybe only about 5%, 4.5% of overall GDP, whereas consumption is 65.8% or more. In the recent numbers, it was closer to 69. But the incredible magnitude of this import surge really overwhelmed the picture. Similar story for this surge in inventories that's making for this massive jump in investment. And of course, all of this is front running of the tariffs. In the first quarter, companies know the tariffs are coming. They don't know exactly what they look like. And so they're trying to buy as much as they can from overseas to build inventories as big as they possibly can to weather a shock for as long as can be made to work. So not surprisingly, there's a surge in inventories and a surge in imports, which makes these GDP numbers fuzzy and easy to argue with, even though the part that matters, the consumption piece, actually gives you the smallest contribution since back here in the second quarter of 2023. So almost a 2-year low on household consumption. That's the part to be worried about here, but it's difficult to say that this is quote-unquote hard data with so much fuzz in the figures. It's a similar story for the jobs report, but somewhat in reverse. Notice it somewhat beats expectations. 177,000 jobs added in April versus 130,000 expected. Now consider what this means. This is outperformance, sure, to the tune of about 47,000 jobs. Except the March number was also revised lower by an almost identical amount, revised down by 48,000 jobs, from 228 to 185. So did the labor market look any better in April than expected? Well, pretty much no. It was exactly as expected, because whatever outperformance you got at the top was taken away in the revision for the prior number, and as we can see, going all the way back to early 2023, the 12-month trend in these 2-month revisions has been negative. That is to say, we've seen some chop up and down on these revisions, but the trend has been toward revisions down to a weaker labor market. And this has been with us for a while. So again, fuzzy data, unclear exactly what the Fed can do with it in an unmistakable way. On the inflation side of things, we've started to see some ticking lower. In particular, the core PCE number that we got reported last week gave us core inflation of just 2.6% year on year. That's certainly a welcome sight. It's the lowest since June of last year. So we're sort of at the bottom of the range that we have carved out recently. But it still looks a bit tenuous. When we look at the 3-month and 6-month annualized rates that the Fed likes to look at to get a view of inflation's dynamics, we can see that only in this most recent set of numbers did we come down a bit from this peak in February, where the 6-month rate and the 3-month rate accelerated. Now, we saw something very similar last year. There was about a 3-month upswell in these dynamics, and this, of course, got the Fed delayed and sounding frustrated, saying we want to cut rates, but we can't because inflation isn't making the progress that we want. We saw it making progress the prior year, but now our hands feel tied. And so they dithered and dithered and dithered until they got to September here, and finally had their big 50 basis point cut right here, said a bunch more easing was incoming, but then, of course, inflation started to go the other way. And at the beginning of this year, really had another sort of unwelcome spike. So far, we're only 1 month into a cool-off. If this was at all instructive, then the Fed has a few more months yet that it needs to see before it's convinced that this thing is moving in its desired direction. Now, for their part, the markets are seemingly giving the Fed permission to cut. Here are the break-even rates for the 5 and 10-year U.S. Treasuries. Essentially, what this tells us is the implied inflation expectations in the bond market, derived by taking the difference between nominal rates, which is what we typically talk about when we say bond yields, and real rates, so-called TIPS yields, inflation-protected security yields. And there, once you take the difference, you get the inflation adjustment that it takes to get from nominal to real. That tells you what the bond market thinks about inflation expectations. And so when you look at what's been happening here, shock of shocks since mid-February or so is a sharp turn down in inflation expectations, which only became more acute at the beginning of April, and these things have not rebounded. Now, the timing here is, of course, very much an auspicious thing. It is the same timing as the turn right here. So just as in mid to late February, stocks said, oh no, growth scare. The PMIs are starting to show that all of this fire and fury around tariff policy is creating uncertainty. Businesses and consumers are holding back on spending. That is a dampener on growth. The economy is slowing and doing so quickly. This is where the market started to freak out. Not sovereign crisis freak out, just heading to recession freak out. And you can clearly see this is where inflation expectations peak and start to come down. Because ostensibly what the markets are saying here is, yes, maybe there is a one-off price increase from these tariffs, Fed, but also we're looking through that to what that price increase will trigger. And that is demand destruction and recession. And so on net, inflation will be lower, not higher, because whatever one-off increase in the price will not be sticky. The economic slowdown, on the other hand, that's going to bite, and that's going to hold. So we see inflation leveling down as though to give the Fed permission and say, you're worried about the wrong thing, go ahead. But that's not enough for the Fed to really hang its hat, or so that it would seem, especially at a time when it is under increasing political pressure. Now, the president has helpfully walked back his threat to extrajudicially fire Chair Powell. That's, I suppose, helpful, but there is certainly no shortage of reversals from the White House, and that's the state of play right now, but who knows if it will continue to be the state of play going forward. And the Fed is very much aware that it is only as good as its credibility. It can't twist the arm of every interest rate in the economy. It has to be a credible lead to follow. And if it feels like it is becoming subservient to political influence, well, then it's not very much of a lead, and the markets will not follow. So, at the risk of getting the entire credit structure unglued, the Fed is not inclined to look like it is kowtowing. So it needs solid, hard data evidence to make the pitch that easing can begin on its own merits. So what we have here then is probably a Fed that comes out vague again and doesn't say much of anything. It says, why would we make a determination here one way or another? Nothing has changed. The data has been mixed. We don't have any more clarity. The fog is thick. We'll see you in June. And to the extent that the markets seem to want more urgency, again, they want 3 cuts this year, and the Fed is only telling them to expect 2, that kind of vagueness is likely to disappoint. So what you might then see is perhaps some extrapolation lower for stock markets. We'll see if they actually make a break through this former resistance turn support right around 55. I would argue you need to do that to really and truly cement that the down move is back in play. Otherwise, this could still be the start of something new that goes higher rather than just a correction. If you got through this level here, well, then the dominant bias is again reasserted on the downside. But the real active story might be here in the bonds, where just as the Fed dithered last year and the market started to make headway to price in more rate cuts later, because the Fed ostensibly is going to have to cut, is already by that point late, and has to then cut more to catch up, so too the markets might conclude is the case this time, and that might see yields disproportionately lower at the long end of the curve. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. In just 30 minutes' time, I'll be on, as I am every Tuesday, with Victor Jones for the Price of Truth. Back with Chris for Futures Power Hour on Friday, and of course, both overtime and this show as well. On with Victor for Tom, with Victor and with Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good luck.